Hello, and welcome back to my financial management series for dental clinic owners. I'm Mohammed Ismail, founder and CEO of Shift Accounting. In my previous videos, I discussed how to read and interpret a P&L and a cash flow statement. Today, I'm going to explore actionable strategies to increase your clinic revenue and manage costs effectively and improve the overall cash flow. So when it comes to a clinic profitability, there's only two levers that you have that you can manage: increase production and manage costs. Okay. Today, I'll show two cost management scenarios and two production improvement scenarios. And then I'm going to take these scenarios and tie them back to the cash flow statement and see what impact that we can generate. Okay. Now, if you have not seen the previous videos, I'd recommend that you go back, watch the two previous videos, and come back to this video so then everything will make sense. Okay, so a reminder, the P&L that we have for this hypothetical scenario is we have a clinic that generated $127,000 in production, in net profitability in 2023. And then in a cash flow statement, the clinic actually had a negative cash flow of $224,000 in the year. Okay. So when we look at the P&L, okay, and look at the opportunities that we have, okay. So let's start with the cost management opportunities. Okay. So number one, I like to look at it from the percentages point of view. Okay. So we could look that dental supplies, is high at 8.5%. Wages is high at 31.7%. Rent is high at almost 9%. Okay. So let's talk about two strategies of cost management and what would the impact would be for this clinic. Okay. Okay. So if everything is the same, okay, and we're able to manage our cost, what would that impact look like for this hypothetical clinic? Okay. So number one, for dental supplies, it shows that 136,000 and total dental supplies at almost 8.5%. Okay. Now, before we go and try to figure this out, I want to make sure that the data has to be cleaned up. Okay. And make sure that that data is clean. The dental supplies does not have, subscriptions, doesn't have small equipments, doesn't have repair and maintenance. So all of that needs to be cleaned up. So we're not going and trying to solve the wrong problem. So assuming that we did that exercise, and this is the true scenario that we have, and supplies are sitting at 8.5%. Okay, and we want to target supplies to be at 5%. Okay, now what would that savings look like? So if we manage to do that and bring down the supplies to 5%, we will have a cost savings of $55,000. Okay, now number two, if we look at wages are sitting at 31%, almost 32%, and we want to target wages to be around the 25%. Okay. Now, how do we go about, managing wages, especially when, we have a tight labor market, we can't find people to work? I would, examine each area separately, meaning what is my wages issue? Is it something in the front? Is it, the number of assistants? Is it in hygiene? Where is that issue that I have? And then try to tackle it. To be honest with you, that's a tough one, especially in the conditions that we have. But let's assume that we were able to, bring down wages, to 25%, and everything else is the same. We are going to be able to save $108,000. So by doing these two exercises, which I can sympathize here and say this is not an easy exercise, but let's say we were able to do them and the savings that we are able to generate is $164,000 in a year. Okay, so that is two ideas or two scenarios where we are going to, cost manage to improve the profitability of the clinic. Okay. Now let's look at, the two scenarios that I have for increasing production. Okay. So the scenario that I have here, and I'm making an assumption for this clinic, is we have two dentists, okay, an owner and an associate, okay. Their average daily production for the owner is 3,400 and for the associate 2,800, okay. And now let's say we are going to increase the number of the average daily production for the owner dentist from 3,400 to 3,800, okay. And we are going to have the associate increase their daily production from 2,800 to 3,400, okay. And let's assume, both dentists work 190 days per year, okay. The impact to dental production would be $190,000 a year, right? So the owner would generate an additional $76,000, and the associate will generate $114,000. And notice that we're asking the associate to add another 600, and we're asking the owner to add 400. And the reason why is because I think a jump from 2,800 to 3,400 is actually easier than a jump from 3,400 to 3,800. Okay, so that's just my opinion here. Okay, so now we added $190,000 in increased production. I want to see that in the bottom line. What would that translate to the bottom line? So my assumption, again, if you watch the other videos, my assumption is everybody's getting an associate fee of 40%. Okay, so we're taking the 40%. And then I'm also assuming, we have dental supplies expense that, that we have to add for this production of 9,500. Okay. And notice that I did not factor in wages, because if you looked at my previous videos, you will know that in this scenario wages were already high, and my assumption is we are going to use we're not adding more staffing to add this production. Okay, so the net increase to the bottom line is 104,000. Okay, so that's a small tweak, right? By consolidating the schedule, by improving, the efficiency in the clinic, and adding just $1,000 for each working day. The net impact for this scenario is $100,000. Okay. Now let's take a look at the hygiene. Okay. So with the hygiene, the approach that I'm taking here is this. So we have total hygiene for 2023 in this scenario is 428,000. Okay. And again, this is a hypothetical scenario, but for your clinic, you'll have more data to play around with it. But I'm going to show you this example, and then you could take this example and work it for your clinic. Okay. So my assumption here is, 428,000 in total production for the year. Divide that by $275 for an average appointment in Alberta. Okay, that gives me 1,558 appointments in the year. Okay, so all I did was took the total production for the year for hygiene and divided by my target appointment, which is about 275 in Alberta. That gives me 1,558 appointments. Okay. One more assumption I'm making, for this hypothetical scenario that I have is the number of active patients, for this clinic is 1,500. Okay. So I want to know the number of visits per active patients. Okay. So if we have 1,500 patients on our charts, how many times did one average patient came to the clinic? Okay. And in this scenario, one active patient came at a rate of 1.39. Now, this is not great, okay? Because in an ideal situation, you have a patient comes at least 2 times a year for hygiene, but the assumption is, they came exactly at their 6-month mark, okay? But that, that's never the case. So, that number definitely will be under 2 but not almost one. Almost one is a really bad number. Okay, hope that makes sense. Okay, so now if we say we are going to increase the number of visits per active patient to just 1.2, all we're doing is going to focus on bringing the patients back, more frequently to the clinic. We're not adding new patients. We're just making sure that people come back and come back on time. Okay, so we're going from a ratio of 1.39 to 1.2. Okay, that's all we're doing. Okay, and actually this is also not we're not setting the bar high. Let's put it this way. Okay, so number of active patients, we said 1,500. Number of visits based on 1.2, so that gives us 1,800 visits. Okay. Or appointments. And again, for simplicity, I'm assuming all of these appointments are perfect. 1 hour appointment. Okay, so that's one more assumption. Okay, so what do we do by just bringing the patient back more frequently? We went from 1,558 appointments to 1,800 appointments. Okay, so total hygiene based on 1,800 appointments. Okay, so again, I just took the 275, multiplied my 1,800 appointments. I have $495,000 in total hygiene production. The increase in hygiene production here in this scenario is an increase of 66,450. Okay, now again, I'm going to do the same thing. I want to know, how does that come to my bottom line. Okay, so we said additional production in hygiene is 66,450. Number of appointments, that's about 300, let's say 300 appointments that we needed. And again, I'm assuming these are 300 additional hours. Okay, each appointment is 1 hour, and I'm going to pay my hygienist about $60 per appointment, which is kind of per hour. So my hygiene wage for this additional revenue is $18,000. Okay, so this would translate to an increase to my bottom line with about $48,000. Okay, I mean, one thing I didn't factor is supplies, so maybe add take away 2% for hygiene supplies. So that's $48,000 an increase to the bottom line. Okay, so now let's look at the cash flow statement. Okay, so remember our cash flow statement here was we had a negative 224,000. Okay, and now we're going to factor these adjustments. Okay, that we did. Okay, so let's go to this. Okay. So the changes that we made, okay, and again, I'm not saying these are easy changes, right? But let's say, we were very successful in making all of these changes, okay? So we starting with a negative 224,000, and we went ahead and assuming, all of this happened, simultaneously. We increased dental production by 104,000. This is again to the bottom line. Okay, and we collected it, right? That's another important assumption. And we increased, hygiene production by 48,000. We cut some costs and saved 164,000. Our cash flow goes from a negative 224,000 to a positive cash flow of 92,000. Okay. Now, in this scenario, I'm assuming that the main dentist already received an associate fee. Okay. And the loan now is paid, okay, or being paid, and all the other obligations are being paid except taxes and amortization. Okay, so this clinic now is able to generate $92,000 of free cash flow per year, and the owner dentist already got paid. Okay, so I hope this short series highlighted how to read the financial statements, kind of what you need to look for, making sure the setup is, a setup that you can actually interpret the information and take action. Okay. The cash flow statement is a statement that is extremely important, especially for clinics who cash flow is a struggle. And then I showed you, 4 strategies on how to improve the profitability of the clinic. Now, the biggest thing here, let's be honest, change is hard. Change takes time, especially when you're dealing with people, right? But the key here is, action, right? Take small steps to make these changes and, evaluate on a monthly basis and, continue to improve. One thing I cannot, underestimate or is how important is to get financial statements that is accurate on a monthly basis, and then your part is to take action. Okay. Thank you again for watching the video. We'll talk soon.